welcome to Opening Bid. I am not Brian Sozzi. I'm Julie Hyman in for Soz today. And Opening Bid is all about serving up investing analysis you need to know to unleash the power of your portfolio. We're digging into what's really moving stocks, giving you the unbeatable context to make decisions with your money. And we're kicking things off with the daily guide to your biggest market drivers of the trading day. So here's what we're thinking and we're watching today. Trump headline risk is back, first of all. From oil to defense stocks to corporate owners of single-family homes, the White House is once again triggering volatility. But investors would do well to remember the lessons of 2025, not least so-called Liberation Day, because stocks, remembered, they tumbled on seemingly capricious tariff rates. Then they rallied almost 40% from the lows when Trump backed off and when remaining tariffs didn't have the expected economic bite. Now, likewise, remember the example of pharma stocks. They were volatile last year on speculation about tariffs and pricing curbs, but then they ended up outperforming the broader market as drug makers struck deals with the White House. And one favored sector, energy, it ended up lagging the S&P 500 by 12 percentage points. So you never know what the end point is going to end up being. Meanwhile, we're also watching the Nvidia China saga, which is continuing. This morning, Bloomberg reporting that China could give the green light to imports of Nvidia's H200 chips as soon as this quarter. Yesterday, though, the information had reported China had asked tech companies to at least temporarily stop those H200 orders. So whatever the outcome of this situation, analysts have told us they're not factoring China revenue into their estimates. So that means that if these orders really do start to flow, it could mean upside for those Nvidia shares. And also, the song remains the same. 2026 looking a lot like 2025 so far for investors. High valuations, the AI trade, Trump headline risk. And we are still, all this time later, having that broadening conversation about the markets. So what gets investors excited this year and really moves the needle? Let's talk about all of this. Here to break it all down, let's welcome in Cameron Dawson, New Edge Wealth Chief Investment Officer, along with Yahoo Finance's Brooke DePalma and Inez Ferre. Thank you all for being here. So, Cameron, I want to start with you here because we've got this Trump headline risk coming back, which is sort of like giving us shades of last year, which of course are giving us shades of Trump 1.0, the first time around. How do you think about all of that headline risk, and do you just ignore it? Do you factor it in? What do you do?
You know, one of the things that we often try to encourage our clients to do is to look through Washington headlines, look through election headlines, because we like things like gridlock because it actually ends up being good for markets. But given that there's now so much policy that's being directed directly from the executive branch, meaning from the president, it is a source of volatility. So in theory, this could raise risk premia, for example, for equity markets, and certainly can cause some big leadership rotations as we look at broader markets. But we bring it back down to just very simple things, is that we're looking at earnings, we're looking at earnings revisions. And so you can have headlines cause an issue with valuations for a short period of time. But if it ends up not actually causing companies to revise their estimates lower, you brought up the example of tariffs as a great one. Estimates ended up being revised higher over the course of the year. That it's something that we can look through and just assess as being a short-term volatility, not necessarily something that can change an investment case.
Yeah, this is a really great point. It's one that Kevin Gordon from Schwab talked to us about in the last hour, too. There's the headline risk and earnings risk, and you really have to separate whether one is going to have the effect on the other. So, you know, in the examples that we got yesterday, Brooke, I know you've been looking at some of the commentary out there in defense stocks in particular, right? And so as we try to figure out, okay, what is the actual effect on these companies, what are you seeing?
Well, JP Morgan coming out with a note saying it's only January 7th, and this is everything that's happened so far, and that's certainly what you reiterated. What we saw was this pullback in defense stocks following the first tweet that we got saying that, they're going to have to ultimately not have buybacks, things of that nature. And then we got this increase to about $1.5 trillion that Trump said would be an increase in the defense budget. That would implicate about a 50% year-over-year increase. Now we see all three defense stocks on your screen moving higher this morning. and because of the implications that this could have. JP Morgan saying that the increase alone would be about 1.5% of GDP, but they also went on to say that there are some implications on whether or not this can happen. And one of those implications is the outcome of the midterm elections. Will this happen? Will this be approved? Will this additional funding get underway by the time those midterm elections, go into effect, that they happen? And so JP Morgan sort of trying to understand that these are all the players out there. This is the case laid out, but the implications are so largely unknown on the ifs this end up does, fully following through here.
Well, and also, whether you're talking about defense or whether you put it on over to the housing executive orders that he's trying to push through, to the pressure he's trying to put on oil prices. You brought up the midterms. Trump is under a lot of pressure on the affordability question. And so it feels like that is going to sift into a lot of things that he's perhaps going to put forward this year. Ines, when it comes to oil prices, I mean, the president, whether it has anything to do with him or not, he's gotten his wish on oil prices. They've remained pretty low. Prices at the pump have remained pretty low. You've been watching the situation in Venezuela really closely, and that headline risk. What are you seeing there in terms of what it tells us about oil prices?
Well, what it tells us is what JP Morgan pointed out this week, which is that if the U.S. has control over Venezuelan oil and Guyana oil and U.S. oil, then the U.S. would have about 30% of the market share of oil. And so that would give the U.S. tremendous pricing power to be able to lower oil prices. And we know that President Trump wants oil prices to be around $50 per barrel. So this all goes in with this theme of also taking control of the oil industry in Venezuela, or holding control over it for years to come, because the U.S. wants to have lower oil prices. And this is his theme, that with lower oil prices, you are able to then be able to grow your economy more. And also with gasoline prices lower, by the way, this is one of the themes that President Trump talked about in a rally that he had in Pennsylvania just in December, saying that affordability is the most important topic for him going into 2026. Of course, this dovetails with the midterm elections, but affordability, yes, is front and center for the Trump administration.
Yeah, he has gotten the memo after sort of being resistant to the affordability theme a couple of months ago. I want to bring back to one other thing that we could be watching in terms of that headline risk, and that's the tariffs, right? Because Cameron, you talked about watching them, we saw the estimates go up even though the tariffs were happening. Well, tomorrow, as soon as tomorrow, we could get changes to the tariffs coming down from the Supreme Court. And it might not just be them throwing them all out or keeping them all. It might be something more nuanced. How do you, as an investor, prepare for that? What are you watching for specifically there?
Yeah, I think we have to wear two hats. We have to think about it in terms of being equity investors and bond investors. On the equity investor side of things, you would probably welcome the relaxation of tariffs because it could help ease some of those affordability issues with consumers. If you look at something like household consumption forecasts in GDP for 2026, they're expected to decelerate from 3.5% growth last year just to 2% growth. So there's this implicit assumption that households will continue to come under pressure. Easing tariffs could certainly help that. You already have companies who have been able to cut a lot of costs in the face of tariffs, so that could help with overall margins if you ease tariffs as well from an equity perspective. But on the bond side of things, the question is how much of that tariff revenue has been earmarked in order to be able to make the deficit look better? And the question is that if you do see an unwind of those tariffs, could we have a scenario that puts upward pressure on things like 10-year yields and 30-year yields, simply because you have those deficit concerns start to creep back in? So it could be very different interpretations come tomorrow with the tariff announcements, depending on whether you're looking at it from the equity or the bond lens.
Oh, and by the way, we got a jobs report tomorrow too, so we could see some effect on the bond market from that one. So definitely a lot to keep an eye on. But yeah, the long-term bond yields is going to be real interesting for the balance of 2026. Guys, I want to switch gears and talk about what's going on with Nvidia and this sort of back and forth on whether they're going to end up being able to ship into China. Something that we've all been watching really closely, as well as the AI trade overall. Brooke, we've been talking about that analysts, they're not even putting China revenue at all in their estimates for Nvidia, right?
Julie, that's completely right. What we're hearing is that this would purely be upside should this go into effect. Should we eventually get this underway, that we're able to ship these chips? Really what analysts are saying here is that they're not calculating China within their expectations for the following quarters. If it happens, then it would be an upside here. But also this would increase the market opportunity entirely for Nvidia, a company that's down from their highs, but also has been doing materially well, considering the fact that this region hasn't been a part of their results in recent quarters. And so analysts purely saying that this would be upside here, that it would increase their total market. And so really remains to be seen on what exactly this could mean and if this could even happen, but purely upside here.
I am struck, Ines, by the idea that I keep hearing this refrain that people are looking beyond the traditional AI stuff, traditional for the past 2 years, the pure play AI stocks like an Nvidia, that they're looking at how AI is going to make its way through the ecosystem. And it's interesting this year thus far, you always get some rotation at the beginning of a year, but we are seeing it's not tech that has been leading some of the early gains.
No, it's been also, you've had the industrial trade, you've had utilities, you've had healthcare as well. So all of the sectors that AI will be touching, and yes, it is beyond just data centers and chips. It is also many other sectors that it is going to be transforming. I think that the healthcare is one where really Wall Street is seeing upside potential there, especially with all the sort of initiatives that the healthcare industry has to be able to come up with better medications and sort of accelerate in seconds to be able to do what it would take in weeks in a lab or years in a lab. So I think there's definitely potential where you're seeing it in the market and just the breadth of the market. And this is the year where, yes, there's still concentration, but Wall Street is expecting that you will see a little bit of expansion when it comes to all the other 493 stocks in the S&P 500 and the impact that AI will have and the productivity impact that it will have on these companies.
Man, that 493 refrain, I've been hearing that for a little while now, though, Ines. It's really happening this time. It's really going to happen here in 2026. I don't know, Cameron. Like I said at the top, this seems a lot like 2025 in so many ways. When it comes to the AI trade, when it comes to broadening, when it comes to high valuations, what's going to get investors excited this year? What's going to actually be a meaningful upside catalyst, if there is one?
Yeah, we've been singing the song from Cabaret. Maybe this time I'll win when it comes to things like value names. I think one of the things that's really fascinating is that you have seen a big bid under cyclical parts of this market really since the beginning of November. You've had leadership, as was mentioned earlier, in things like industrials, metals and mining, of course, is what we've seen within the precious metals, as well as in industrial commodities, have been extraordinarily strong. And so the equity market, and I would also argue metals markets, currency markets, and even global bond yields pressing higher and long end of curves are effectively signaling that there is a hope and optimism for some kind of global reacceleration and growth. Now, as of right now, it is only just hope and optimism, meaning we're not necessarily seeing the data to support that cyclical reacceleration, but it's always really important to remember price leads data, meaning the market will move before the data necessarily confirms it. And it's also true that price leads narrative, meaning that prices will move before we come up with a story about it. So it could be that we're on the precipice and maybe this time we'll win. It comes to that broadening out, but eventually we'll need to see the data, fundamental data support it.
Well, we're going to start to get some of that data tomorrow on the macro side in the form of the jobs report, and we'll see what happens with the tariff ruling. Ladies, thank you so much. Really appreciate it this morning. Coming up, the environment for deal making is picking up. We'll talk to Apollo Global Management's co-head of equity about his outlook. That is next on Opening Bid. Deal activity is expected to accelerate this year after rising in 2025. Yahoo Finance executive editor Brian Sozzi sat down on the Opening Bid Unfiltered podcast with Apollo Global Management co-head of equity David Samber to talk about the state of private equity.
I think private equity is at kind of a key pivot point. Our firm's been doing this for 35 years. I've been doing it for 22 years.
Really?
Yeah.
Wow.
Goes by quick. It's like kids. Someone told me, we just sent out the holiday cards and my kids are 15, 13, and 10. Someone texted me yesterday saying, wow, it goes by in a blink. It all goes by in a blink. Yeah, I'd say in the early days of private equity, it was less competitive and it was very much financial engineering. The benefits of leverage, changing capital structures, and a different way of capitalizing companies. And then it moved to the operational phase where people were trying to add value by making companies better, grow faster, be more profitable. That still is a big part of it. Somewhere along the way in the last 10 or 15 years when rates basically went to zero, people got lazy and just kind of rode the wave. And that wave crashed quite spectacularly in 2022. I think the industry is still picking itself up. I think a lot of people bought assets at the peak at valuations and based on assumptions around rates, around the external environment that are no longer true, and they're struggling to exit. So I think the industry really needs to get back to basics and focus on simple things like buying a good company at a good price, making it better, and then actually have an executable plan to return capital, because unlike other investing strategies, this is a cash investing strategy. What I mean by that is our investors are in a drawdown fund, and all that really matters is how much money did we give them back versus what they invested. Yes, you take a report card along the way. You want to know how the companies are doing. You want to mark the portfolio to market. But simply put, private equity is you give me $1, I give you back $2.50 in 5 years, and you're happy. I give you back $5, you're really happy. I give you back $1 or less than $1, you are not happy.
You're not happy.
If I do it inside of 5 years, it's great. If it takes 10 years, which is kind of where the industry is trending, the average hold period for investment now is 6.5 years, drags down returns. So we just got to get back to basics.
Where have you spent the bulk of your time, let's say the past 3 months? Is it focusing more on opportunities or thinking about how to exit a company?
So it's got to be all is the answer. I know that's probably not a helpful answer. You have to be buying, we're not shifting towards buying or selling. Obviously, the environment becomes more conducive to one or the other at certain points in time based on your view of value. But we are constantly investing, and we want to be investing. We want to be opportunistic, but we're finding good opportunities even in bad markets, which is a little bit different for us versus other people. So in 2022 and 23, when rates spiked, we were very active deploying. When the industry deal volumes went down 70% from 2021 to 2023, we kept our deployment pretty flat at about $7 to $9 billion per annum over that time period. It was a tougher time to exit during that time period, without a doubt. It's been a tough time to exit pretty much since 2022. We've been pretty active, though. This is the second largest year in our history for distributions. You got to get creative. Yahoo, in the interest of full disclosure, is one of our investments, and I am on the board. But Yahoo's a great example of bought in 2021, contrarian investment at a contrarian time in the cycle, bought well, I would say, strategically sourced, well capitalized, but a lot of interesting things done to make the portfolio simpler, improving and upgrading the talent and the management team. Which
Amazing CEO, Jim Lanzone.
But then hustling to return capital along the way and returning that capital to investors. That's private equity.
Where are you? So the market is trading at very rich valuations. How does a company like Apollo find opportunities in a market that, from the outside looking in, like every day it seems to be going up, whether it's from tech or potential for more rate cuts? Like, how do you find opportunities?
There's the narrative that's out there, and I know you spend your time across all the investing asset classes, but a lot of the talks around public markets, right? There's a public markets narrative that's out there that I think is certainly a narrative that tells you something, but that's not really applicable to the world we live in. That's not applicable to not only is that not applicable to Main Street America, that's not applicable to most of the economy. So for instance, 90% of companies in America with $100 million or more revenue are private today. Today, there are half as many public companies as there were in America 25 years ago. 9,000 going to about 4,500. And every year, for many reasons, but every year, more companies are taken private than deposited back into the public markets. And we've been a big driver of that with our strategy. Why is that? The public markets have become a less hospitable place for non-simple, non-thematic companies. And you could see it in the returns. So you're right. The aggregate valuation in the S&P is in the top 5% historically. The concentration for the S&P is also in the top 5% historically. You peel back the onion of those 7 companies or the top 40 companies, and you see a very different story with regards to valuations, with regards to returns over the last 1, 3, and 5-year period, and you can find value. And we have been finding value in the public markets. So when you look below the surface and you question these narratives, you can find interesting opportunities, and we have been.
How do you know there is untapped value? I imagine it goes beyond seeing something trade at 10 times forward earnings. Like, how do you know? What are your signals?
Yeah. Valuation multiples are not the be-all and end-all. When I say value, when I think about what it is we're trying to do, try to keep it simple, it's attractive risk reward. What do I mean by that? I mean highly unlikely to lose your capital through attractive purchase price or really through more attractive leverage. Paying less for a company means you could put less leverage on it and still get that same return. But then it's, what do you do to manage the company? You could de-risk the company and tilt the risk reward in your favor through active management, all the stuff we talked about, the strategy of the company, the management team, how you change the portfolio, and then returning capital along the way. So the valuation is certainly a marker, but companies usually trade for low valuations for a reason. So the trick is making sure you're finding that company that you feel like you're buying. And this is different for us. A lot of people in private equity have moved away from this, and they're focused on really just buying quality, and they're less focused on feeling like they're playing with the lead up front. For us, there's 3 ways to make money in a private equity investment, or 3 ways to create alpha. Alpha on the buy, alpha on the build, and alpha on the exit. Historically, most people focused on one of the first 2. I'm buying well, I'm creating value up front, or I've got a great machine to make my portfolio companies better. Those are tables. You got to have both. And you really have to also have a way to create alpha on the exit now too, because the exit environment has become much more challenging, and that's both cyclical and secular. So for us, we have to buy something where we feel like there's some margin of safety up front, there's some asymmetry to the return profile, but then we're doing all the things that we need to do to make the company grow faster, be more profitable, allocate capital better, and then manage that company and manage the portfolio along the way to be de-risking and returning capital to our investors, which is the business model. You got to do all 3.
Coming up, more me. Yahoo Finance's Market Catalyst is next. We'll bring you the news behind the market moves for the trading day. You don't want to miss it.